On the morning of June 28, 2015, Nikos unlocked his Athens pharmacy and checked the safe behind the counter. Inside sat 43,000 euros in cash, supplier payments, payroll reserves, 3 months of operating cushion. His wife Eleni kept their household savings in Alpha Bank, 72,000 euros they had accumulated over 14 years. Both accounts held the same currency. Both had been legal and accessible the day before. Nikos had done everything the Greek middle class was supposed to do. They saved in euros, not drachmas. They held deposits in a bank capitalized under European Union supervision. They followed every rule. By 9 that morning, steel shutters covered every Alpha Bank branch on their street. The ATM outside dispensed 60 euros to Eleni, then flashed a daily limit message. She tried again at the Eurobank location 2 blocks away. Same message. The cash in Nikos' safe remained fully accessible. The 72,000 euros in Eleni's account, the same euros issued by the same central bank in the same country, had become permission-gated overnight. Greece had not run out of money. It had run out of the legal authority to let its citizens access their own deposits. Across Athens that morning, families discovered that a euro in physical form and a euro in digital form were not the same instrument. One required no permission. The other required permission that no longer existed. What happened to Eleni's 72,000 euros is not the story you were told. The mechanism was structural. It was visible in advance. By the end of this, you will see exactly who moved their money to Frankfurt in March and why. To understand how this happened, we need to go back 3 months. March 2015, Brussels, a conference room in the Eurogroup headquarters. Yanis Varoufakis, Greece's finance minister under the new Syriza government, walked in with a debt restructuring proposal. The Greek state owed more than it could pay. The proposal asked for relief. Joran Dijsselbloem sat across the table, Eurogroup chair, representative of the creditor nations. He said Greece must accept the existing bailout terms. No restructuring. Accept or face liquidity withdrawal. The meeting ended with no agreement. The next day, the European Central Bank, the ECB, convened its governing council on an emergency call. The question on the table? Emergency Liquidity Assistance, or ELA, the mechanism that kept Greek banks solvent. The ECB had been providing it. Now the council made it conditional. ELA would continue, but only if Greece showed progress in negotiations with creditors. Here is how that authority worked. Under Article 14.4 of its founding statute, the ECB controls Emergency Liquidity Assistance, that ELA line we just named. A national central bank, in this case the Bank of Greece, can hand emergency cash to its commercial banks, but only up to a ceiling the ECB Governing Council sets. The national bank cannot exceed it. June 28, 2015. The council met in Frankfurt, Mario Draghi presiding. Greek depositors were withdrawing. The banks were running low on physical cash, and the Bank of Greece requested a higher cap. The council said no. The decision was published that afternoon. One sentence mattered. The Governing Council decided to maintain the ceiling to the provision of emergency liquidity assistance to Greek banks at the level decided on Friday, June 26, 2015. 89 billion euros. That was the cap. The council froze it there. Here is what that meant in Athens. The Bank of Greece could not provide more cash. The commercial banks could not honor withdrawals beyond existing reserves. The Ministry of Finance chose orderly closure over open failure. June 28, 2015, the same day, the Greek government issued a decree, Government Gazette A65. The decree closed Greek banks until further notice. It imposed a €60 daily limit on ATM withdrawals. The banks stayed closed for approximately 1 week. Yannis Sternaris ran the Bank of Greece, but he could only allocate what the ELA cap allowed. He could not raise it. Greek commercial banks held deposit ledgers far larger than 89 billion euros. The ECB had capped the cash that could back them at that figure. That gap was the mechanism. Reaching a ledger balance required converting it into cash, and that conversion needed liquidity the ECB now refused to grow. Capital controls did not destroy euros. They created categories. Cash in Athens, fully transactable. Deposits in Greek accounts, permission rationed at 60 per day. Same euros outside Greece, no restriction. The ECB did not destroy Greek deposits. It removed the Greek state's ability to honor them.
Pangrati, a middle-class neighborhood east of the Athens city center. Nikos' pharmacy sat 3 blocks from the apartment he and Eleni had lived in since 1998. On the morning of June 28, 2015, he unlocked the steel door at 7:30 and checked the safe in the back room, the cash reserve he had built for supplier payments and payroll, because wholesalers wanted paying within 10 days and transfers ran longer. Tens of thousands of euros in stacks of 50s and 100s, wrapped in pharmacy receipt paper. At 8, the radio confirmed it. Cyprus had announced capital controls overnight. Banks closed. ATM withdrawals capped at 60 euros a day. Nikos did not panic. He had cash. Suppliers would be paid. His assistant would get her Friday salary. He could operate. Eleni stood in line at the Alpha Bank ATM on Dimitris Street at 9:15 that morning. 47 people ahead of her. She waited an hour and 12 minutes. When she reached the machine, she withdrew 60 euros. Her balance showed roughly 72,000. Household savings from 12 years of municipal work. Salary deposited twice a month. Almost never touched. She walked home with 60 euros in her purse and did the arithmetic on the way. The mortgage was due July 15, 840 euros. At 60 a day, it would take 14 days to assemble that much in cash. The payment was due in 17. She had just enough time if she went to the ATM every single day and if nothing else needed cash. Over the next week, Athens split into 2 economies. Nikos paid his pharmaceutical supplier on July 2. The wholesaler arrived at the pharmacy. Nikos opened the safe. He counted out 8,400 euros in cash. The supplier wrote a receipt. He locked the safe again and noticed that for the first time in years, he had thought of the cash inside not as a precaution, but as the only part of his business the government could not pause. The transaction took 4 minutes. No delay, no negotiation, no bank involved. That same day, Eleni queued at the ATM on Dimitris Street. 23 people ahead of her this time. She withdrew her 60 euros. She bought groceries at the corner shop: bread, tomatoes, feta, olive oil. The shopkeeper accepted her cash without question. She still had 42 euros left. She put it in an envelope in the kitchen drawer with the euros from the previous 6 days. 420 euros total. 1 week of savings from her own account, accessed in daily 60 euro installments. On July 8, she tried to pay the electric bill online. The utility company's website displayed a message: "Card payments temporarily unavailable. Please pay in cash at authorized locations." She took 112 euros from the kitchen drawer. She paid in cash. The clerk stamped her receipt. "Everyone is paying cash now," the clerk said. Eleni thought about her 72,000 euros. It existed. It was legally hers.
The account showed the balance every time she checked, but she could not use it for the mortgage payment.
She could not use it to repair the washing machine when it broke on July 10. She could not use it to buy a used car. Her brother had offered his fiat for 4,000 euros cash, a family price, held only until the weekend. She watched it go. She called Alpha Bank on July 13. She explained that the mortgage payment was due in 2 days. She asked if the bank could make an exception for the transfer. The woman on the phone said exceptions were being reviewed on a case-by-case basis. But I can tell you now, the woman said, bulk withdrawals remain prohibited. Can you make the payment in smaller amounts over time?
Eleni said the mortgage servicer would not accept partial payments. The woman on the phone said she was sorry. On July 15, Eleni's mortgage payment did not process. The servicer sent an automated notice. Payment overdue. Late fee assessed. She had 72,000 euros. She could not access it to make an 840 euro payment. Nikos kept paying through July. His assistant, a medical supplies vendor, fresh inventory, all in cash from the safe. The business kept running on the only money the state could not pause.
By the 3rd week of July, the neighborhood had learned the new rules. Cash was sovereignty. Euros in a bank account were a number on a screen. A promise the institution could not honor in the form you needed, when you needed it. Euros in a safe were an instrument you could deploy. Eleni kept going to the ATM every day. She kept putting 60 euros in the kitchen drawer. She kept watching her account balance stay at approximately 72,000, minus the 60 euro daily decrements. She did. But here is the kicker. Between March and June 2015, roughly 40 billion euros walked out of Greek banks, legally, unrestricted, in wire transfers to Frankfurt, London, and Zurich. The Bank of Greece bulletins recorded it. Large account holders read the ECB negotiation breakdown as a signal and moved first. Dimitris was a shipping executive in Kolonaki. In March 2015, he moved 400,000 euros to a Deutsche Bank account in Frankfurt. No restrictions existed at the time. No law was broken. By June 28, when capital controls arrived, his Frankfurt account sat outside Greek jurisdiction. The Greek state could not reach it. Eleni had no reason to move money in March. She was a pharmacy owner. She read newspapers, not ECB negotiation minutes. The capital controls appeared overnight. Dimitris had already left. This was the wealth hierarchy before the crisis fully manifested. The record from Cyprus in 2013 tells the same story. Bank closures in March, Cypriot elites watching from London accounts they no longer kept in Nicosia. By the time Eleni joined the ATM queue on June 28, the wealthiest Greeks were watching from accounts they no longer kept in Athens. This was not an accident. The mechanism has a name. Monetary union without fiscal union. The Eurozone was built with a structural split. Greece controls its banking system, but the ECB controls the supply of euros to it. When sovereign debt reaches crisis, that split forces a choice, and the choice always lands on the depositor. Capital controls are the legal expression of that choice. They restrict domestic banking. They cap ATM withdrawals. They freeze transfers between Greek accounts. What they cannot do is touch euros already held outside Greek jurisdiction. Dimitris' Deutsche Bank account in Frankfurt, German jurisdiction, untouchable. Eleni's Alpha Bank account in Athens, Greek jurisdiction, rationed. Same currency, different instruments. The pattern has a history older than Greece. Cyprus did this in 2013.
Banks closed, then reopened with large deposits forcibly converted into bank equity that lost most of its value, while account holders who had moved money to London before the closure kept theirs whole. Argentina did it at the end of 2001. Deposits frozen, withdrawals rationed to a weekly trickle, and savers who had not already converted out the door watched the value of what remained collapse against the dollar. Different decades, different currencies, the same shape. Sovereign crisis, central bank liquidity withdrawn, domestic banks closed, capital controls. Every time, the money that left jurisdiction before the door shut stayed money. The money inside became a permission.
Go back to the kitchen drawer in Pangrati and the envelope of €60 withdrawals. Eleni did everything the careful are told to do. She earned in euros, saved in euros, kept those euros in a supervised European bank for 12 years. Nikos, 3 blocks away, did the thing the careful are warned against. He sat on a pile of cash in a safe. When the permission structure changed overnight, the rule follower was trapped, and the cash holder was free. That is the inversion this episode exists to show. The safety was the trap, and it was a trap built into the instrument, not into anything Eleni did wrong. Here is what the forensic record documents. First, the euro that broke Eleni was not destroyed and not devalued. It was made conditional. The ECB froze the ELA ceiling at 89 billion on June 28, 2015. The Greek state could no longer convert ledger balances into cash on demand. The number on her screen never moved. Second, the split was jurisdictional, not monetary. A euro in a German account faced no restriction. The same euro in an Athens account was rationed to $60 a day. Identical currency, different sovereignty exposure. Third, it was visible in advance. Roughly 40 billion euros left Greek banks between March and June. The people who read the negotiation breakdown, Dimitris in Kolonaki, moved first. The people who read the newspaper found out on June 28.
The pattern is not Greek and not new. Cyprus, Argentina, and every defended deposit base before them ended the same way. The money that left the jurisdiction before the door shut stayed money.
The forensic question is not whether your bank is solvent. It is whether the currency in your account is the same instrument as the currency in your hand. And on what day and by whose permission that stops being true. Eleni's 72,000 euros were never stolen. They sat in the Alpha Bank database the entire time, legally hers, and for weeks she could touch 60 of them a day. If forensic breakdowns of how that permission structure is built are why you are here, subscribe. That is the only thing this channel examines.